Right now, there's roughly $500 billion in borrowed yen circulating through the global financial system, not invested in Japan, not building Japanese companies, just borrowed cheaply in Tokyo and deployed everywhere else on the planet. Into US tech stocks, Mexican government bonds, Australian real estate. It's one of the largest quiet funding mechanisms in modern finance, and most people who are affected by it have never heard its name. It's called the carry trade, and its architecture explains something most market analysis completely misses: why a central bank decision in Tokyo can crash the NASDAQ in a single afternoon. Here's how the system actually works. A carry trade is, at its core, an interest rate arbitrage. You borrow money where it's cheap to borrow, and you park it where it pays more. That gap, the difference between what you owe and what you earn, is your profit. No product, no innovation, just a spread between two numbers in two different countries. And for more than 2 decades, no currency on Earth has been cheaper to borrow than the Japanese yen. After Japan's asset bubble collapsed in 1990, the country entered a deflationary spiral that lasted in various forms for over 30 years. The Bank of Japan responded by doing something no other modern central bank had done: pushing interest rates to zero, then below zero. For most of the 2010s, the BOJ's policy rate sat at negative 0.1%, meaning banks were literally paying for the privilege of parking money in Japan. Meanwhile, the US Federal Reserve was charging 4, 5, sometimes 5.5%. That differential, that gap, became an open invitation. Think of it like finding a vendor in a game selling a resource for almost nothing, while another vendor across the map is buying that same resource at a massive premium. The rational move is obvious. You borrow yen at near zero cost, convert it into dollars or pesos or Australian dollars, and invest in anything yielding more. US Treasuries, corporate bonds, equities. As long as the gap between borrowing cost and investment return stays open, and the yen doesn't suddenly appreciate against whatever currency you've converted into, you collect that spread every single day. And for years, it worked beautifully. The yen didn't just stay weak, it got weaker. Between 2022 and mid-2024, the yen fell from around 115 per dollar to nearly 162, its lowest level since 1986. That meant carry traders weren't just earning the interest rate differential, they were earning currency appreciation on top of it, a double payoff. The trade became so reliable that it attracted everyone: hedge funds running billions in leveraged positions, Japanese pension funds and insurance companies sending capital overseas, and even Japanese retail investors, affectionately nicknamed Mrs. Watanabe, speculating on foreign exchange through margin accounts. BIS estimates put yen-denominated loans to non-banks outside Japan at roughly 40 trillion yen, about $250 billion, by early 2024. But that number only captures direct loans. When you include offshore debt instruments, special purpose vehicles, and the $14 trillion FX swap market where yen is exchanged for other currencies, the true ecosystem is vastly larger. Nobody knows the exact figure. That's part of the design problem. Because here's the architectural flaw built into every carry trade. The returns are small and steady, but the risk is sudden and violent. You earn a few percent per year, drip by drip. But when the trade reverses, it reverses all at once. The trigger is usually the same. The funding currency, in this case the yen, starts getting more expensive. Either Japanese rates go up, or the yen starts appreciating, or both. When that happens, the math flips. Your borrowing cost rises. Your currency conversion starts working against you. And the elegant little spread that was printing money last month is now hemorrhaging it. But it gets worse because carry trades are almost always leveraged. That borrowed yen isn't sitting in a savings account. It's been amplified through derivatives, margin, and synthetic positions. So when the yen moves against you by 5%, your actual losses might be 20, 30, 50% of your equity. Margin calls hit. You need to sell your assets, the US stocks, the bonds, the peso positions, to buy back yen and close your loans. And so does everyone else running the same trade at the same time. This is where the system dynamics get genuinely fascinating. A carry trade unwind isn't a single transaction, it's a chain reaction. Funding costs rise, The yen strengthens as borrowers rush to buy it back. That strengthening yen triggers more margin calls, more selling, more yen buying. Liquidity thins because everyone is moving in the same direction. Volatility spikes, which triggers automated risk systems to cut positions. And suddenly, a strategy that felt like free money becomes a mechanism for transmitting panic across every asset class it ever touched. We've seen this play out before. In October 1998, after the Asian financial crisis and Russia's debt default, the yen carry trade unwound so violently that the dollar-yen exchange rate recorded its largest single-day move since the collapse of Bretton Woods. The resulting cascade helped push long-term capital management, a hedge fund staffed by Nobel laureates, into a collapse that nearly took the financial system with it. The yen appreciated 20% from its trough in a matter of weeks. Then in 2008, as the global financial crisis unfolded, carry trade unwinding accelerated the contagion. Investors who had borrowed yen to invest in everything from Icelandic bank bonds to US mortgage-backed securities all scrambled for the exit simultaneously. And then there's August 5th, 2024. The Bank of Japan, after decades of holding rates at or below zero, had started cautiously normalizing. In March 2024, they ended the world's last negative interest rate regime. Then, on July 31st, they raised rates again to 0.25% and signaled they planned to keep going. It wasn't a dramatic hike by any global standard, but for a system that had been calibrated around Japanese rates never moving, it was seismic. Within days, the yen surged. The dollar dropped roughly 12% against the yen in a matter of weeks. And then the cascade hit. On August 5th, Japan's Nikkei 225 fell 12.4%, its worst single-day crash since Black Monday in 1987. The S&P 500 dropped 3%. The VIX spiked above 60, a level typically reserved for full-blown financial crises. The Mexican peso cratered. The Brazilian real and South African rand, popular carry trade destinations, all got hammered. Not because anything changed in Mexico or Brazil or South Africa, but because the funding source on the other side of the planet shifted by 0.25%. By the end of the week, markets had mostly recovered. The BOJ's deputy governor walked back the hawkish tone, promising no more hikes during market turmoil. But the episode revealed the architecture underneath. It showed exactly how many global assets are quietly sitting on a foundation of borrowed yen, and how quickly that foundation can crack. What makes this especially worth understanding right now is that the structural conditions haven't resolved, they've intensified. By December 2025, the BOJ raised rates again to 0.75%, the highest level since 1995. Japan's 10-year government bond yield broke above 2% for the first time since 1999. Inflation in Japan has been running above the BOJ's 2% target for over 40 consecutive months. The era of free yen is ending, and the BOJ has explicitly signaled more hikes are coming if economic conditions hold. Meanwhile, on the other side of the trade, the Federal Reserve has been cutting rates, narrowing the very differential that made the carry trade attractive in the first place. The gap is compressing from both ends. Now, here's what most analysis gets wrong. They frame this as a binary. Either the carry trade unwinds catastrophically, or it doesn't. But the real system is more nuanced than that. Japanese pension funds, life insurance companies, and retail investors through NISA savings accounts still hold enormous foreign asset positions, and their repatriation patterns are structural and gradual, not panicked. From January to October 2025, Japanese investors actually purchased 11.7 trillion yen in overseas debt, far more than all of 2024. The money is still flowing out. The carry trade isn't dying, it's being repriced. The real question isn't whether the carry trade will unwind. It's whether the repricing happens gradually, through slow position adjustments and reduced new leverage, or whether it happens in another August 5th style cascade. And that depends on something no model can reliably predict: the speed at which expectations change. This is the fundamental asymmetry built into the carry trade's architecture. The profits accumulate slowly, like grinding through a long campaign, but the losses arrive in a single, concentrated burst, Like discovering the boss has a phase 2 you never prepared for. The system works until it doesn't, and the transition between those two states isn't gradual. It's a phase change. If this kind of system-level breakdown is useful to you, understanding not just what happened but the architecture underneath, subscribe to 8-Bit Economics. Every week, we strip complex financial systems down to their core mechanics. No hype, no predictions. Just the underlying code that actually runs the economy. Hit subscribe, leave a like if this shifted your thinking, and drop a comment with your take on where the yen goes from here. By the time everyone sees it coming, the smart play is already over. So here's what the carry trade really teaches us. It's not a story about Japan. It's not even a story about currency. It's a story about what happens when an entire global system optimizes around a single assumption. In this case, that Japanese interest rates will stay near zero forever. Trillions of dollars of financial architecture got built on that premise. Strategies, derivatives, funding structures, pension allocation models, all quietly calibrated to a world where borrowing yen was essentially free. And now that assumption is changing. Not collapsing. Changing. The question every participant in global markets faces, whether they know they're exposed to this or not, is how well the system absorbs a shift in the one variable everyone agreed would never move. History says, sometimes gracefully, sometimes not. And the difference between those two outcomes is rarely visible until it's already too late to reposition. The most important trades in finance are never the ones everyone's watching. They're the ones running silently underneath, funding everything else. Until they stop.